Chat. So I think Anar has just joined. I'd like to introduce him. We've known each other for quite a long time. He's a really good higher time frame trader and swing trader. A lot of good option trades that he does, and he's really well versed in that. So I'd like to introduce him. Hopefully he can say hi here and speak a little bit. Yeah, I mean, I might even spill some sauce I haven't talked about yet. So if you want to take notes, feel free to do so. There's always something there. Um, If you guys haven't checked it out, I just put out the video on YouTube, right, talking about the indicator in of itself, intraday and weekly, and just breaking it down for you guys. It's so simple. It's literally four components, just the intervals, these root candles, as Cobra likes to call them, the magical boxes, right? And then we have the previous ranges and AMRP. And I can quickly go over it again. It's so simple where when a model pops up and populates on the chart, as I mentioned earlier, this is absolute discount, absolute premium relative to this time, right? In the PM session, Thursdays, I specifically chose this day because with the data, we tend to see a little more volatility in the PM on Thursdays in this specific time. So this is the discount premium, and then this magical box, also known as the root candle, that helps me to gauge premium and discount as well, right? I can use this as a draw on liquidity. I can use it to support price. If I see a breakdown, I can use it to short, although I'm not looking to short today, just saying that's the protocol. And you can also target AMRP with it, right? So let's take this thing off here for a second. We just have the root candle there, right? Just using this is my discount and premium relative to this time. But we're now below, so technically we're at discount relative to this candle here. I'm going to look at the 5-minute. If you're having a tough time, by the way, as a trader, just jump to the upper time frames. Go to the 3, 5, 10, 15. You have a much easier time. It'll help your patience. It'll help you evolve. Since price is fractal, you'll probably see the same exact entry criteria as you see on the 1-minute. So if you go to the 1-minute, you'll see a lot of entry possibilities, which is cool. But to refine it further, just jump to the 5 or 15. So we're discount of this root candle. I then look at the 5. Is there a reason for me to possibly look for longs within this price leg here? And perhaps there is. Relative to this price leg here, there's some fair value gaps inside there, okay? Below equilibrium, that's the fair value gap at discount. So I might have my eyes peeled on that one, okay? Next, we can look at the previous model range. This is best for consolidation periods. So whenever you see consolidations, turn this pupper on right here, okay? I highly recommend it. Let me show you guys what I mean. If we go back to the consolidation areas here, let me just turn off root candles so you guys can get a clear picture. When you start to see price consolidate quite frequently, turn that setting on. Highs and lows in equilibrium. We'll make this solid just so it's easier to see. This will be discount and premium of the previous model. What I mean by that, this black line over here is just the high of the previous model. This black line down here is the low of the previous model. This blue line is 50% of that. So as we can see here, this is Judas. That's the previous model. If I'm looking for shorts, great. I'm going to look for shorts here. If I'm looking for longs, great. I'm going to look for longs down here. So whenever you're in a consolidation environment, know when to use the tool properly. Just turn that thing on. Boom. Easier read. Easier to digest price. Now, if you're looking for a continuation, turn those root candles on. As we can see, with the root candles, we can capture pretty good entries. Am I going to take, again, every single entry that I see? No, but if there's a really good setup, I will likely take it. For example, when you're looking for a continuation of a trend, wait for a close above the root candle, comes back down, gives you an opportunity to long, continues higher, closes above all of these root candles, which are the magical blue boxes, and we start to see price hold those relative to this internal high. It takes it out, comes back, uses these as support, and just flies off after 1149, which is so beautiful, right? Once you see everything together, there's no going back. I mean, if you have some form of a price entry criteria, change it in state of delivery, you're using order blocks, fair value gaps, inversions, look how beautiful it looks compared to not knowing exactly what price is doing and where it's at. You know, if you're just looking at raw price action, it's still doable. It's just a bit more difficult, right? If I know I'm waking up, let's say 10:20 a.m., I wake up, I slap this thing on, boom, I know this is my discount, I know this is my premium. I'm going to look for my entry criteria here if the higher time frame says so, and that's all I need. So definitely tons of opportunities when it comes to that, and that's all it really is. And it helps with patience. That's why it's there for, right? If we're waiting for discount, I'm going to look for longs here. It's that simple. I don't know if you want to add anything, Anar, but that's the way I simply utilize it all. Yeah, they got names. Each model has a different name, so that way we can help distinguish them. Like, oh, this model did that today, or that model did this. I'm expecting this model to do that. It's pretty cool. Every model works the same. It's the same thing. Like I mentioned, if we're in the middle of the range, I'll probably use the root candle and observe that, like we were in the morning live session. Otherwise, this is going to be the maximum target going into the rest of the week. So that's what I'm going to have my eyes on, right? Another thing I like to talk about, if you have access to this indicator, just simply understand this, that if I go to the one, if I'm not really expecting much of an expansion, let's say, like price has been kind of clunky in the morning, for example, here, it's not moving too much. You know, you can really notice I have a setting of 9. So if I go down here, this is the model look back. What does this mean? It just means it goes back to the 9 previous models, grabs that data, slaps it on into the indicator, and measures the volatility based off that. So why is that important? Really understand this. If I'm expecting an expansion, I'm going to have much higher targets. So I'm going to look for a broader expansion and movement, right? On a large expansion day. I will then use 9. If we're still in a consolidation and we're not really moving too much, I'll put 3 or 6. And you'll see the difference as it populates. Look at that. Overextends, slaps back into the range. Overextends, slaps back into the range until the next time interval is over. So if I'm not expecting, right, perfect, yeah, well said. You guys get that? So that's why if you have a warning sign pop up, it's because you most likely don't have enough data to your trading view plan. So for example, I have the premium version, I can use 9, no problem, right? Populates quickly, displays on the chart, it's quick, efficient, and speedy. So if you're having a warning sign pop up, that is due to the data limitation on TradingView. But regardless, any questions here so far that I can answer? This is pretty much the quick utilization and summarization of what DTT is. I simply just sit on my hands, wait for price to come to me, look for my setup, follow higher time frame order flow, look for a setup and enter, set my risk parameter, and that's it. Right from there, I can target the root candle, and or if I'm feeling really bullish, target this area up here. That's what we do day in, day out, right? You can do this with any ticker symbol. It could be YM, could be the S&P, as we see here. It could be on crude oil. Same thing. Quick little tap on AMRP, bounces off that, comes back up. So this happens day in, day out. I mean, if you're struggling, in my opinion, to understand where price is likely to go, where to look for discount and premium, you are in a specific time, you're wondering, where should I look for longs? Where should I look for shorts? That's what this is about, right? And then as far as the intervals, that's where you can expect or would like to see reversals possibilities, right? So as we discussed, you can see how it's retracing back down now. So I'd like to see how it forms a possible setup down there. Obviously, this is all just for educational purposes, but you can see how waiting patiently instead of longing a breakout or some random setup down here, up here. So for example, if I just take that off, there's all kinds of setups here, right? There's an inversion, there's a change in the state of delivery here, there's this and that. But if I slap this back on, I know this is where I should be looking for longs, not up here, okay? If we're really bullish, can I use this root candle for a continuation? Yes, I can. But the risk would be below the root candle. If you see a break below, a close below specifically, like this candle here, comes back up, rejects the opening price, then yeah, you should probably be a little careful, right? You should wait for AMRP to be tapped instead. So we have that level down here. And someone just asked, how do I incorporate the weekly DTT? Well, I've got some sauce to spill here, but if you're willing to take notes, it's pretty simple framework. If I have both of them on here, what do we see here? Obviously, we've been more of a trend environment, but you see this fat blue box here. It's a funny way of putting it, but that's the root candle on the weekly time frame. You see that right there, right? Since that is a potential draw on liquidity, look at price just beautifully going back down to AMRP here. If I expect that area to be a nice support, quotation marks around support, for price, watch what happens, and we'll see it here. If we tap this root candle, we go back to the 1, and then we can see that below that, it's going to be below AMRP. What does that mean? It means we're absolute discount within this time to this time. And so if I have the root candle there, that's going to be a really top tier entry if there's a setup there, right? So there's different fractal models because this is the 1 minute. We have the weekly on the 5 and the 15. This is where the part where you take notes right here. If I see a weekly roots or AMRP, drop down to the intraday models, find a sharper entry. You can do this for Asia, London, New York. So if you ever see me trade Asia, it's because I'm doing this exact thing right here. Same thing. If I see a weekly AMRP, drop down to the intraday models, find a sharper entry on a root or AMRP. And there's tons of examples of this. If you backtest, you'll see this happens quite often. Like we tap a weekly root candle or a weekly AMRP, you go to the lower time frame, it's doing the same exact thing. your entry is just going to be insane. So that's what you should look out for. But this here, this is two separate models, root and an AMRP, right? I don't really talk about that yet, but just spill the beans right there, spill the sauce. So now we're waiting for a retracement here. A couple things to look out for. We have the root candle down here from the weekly. I'll just make that really bright blue. And if you guys notice, I'd probably see in the recording or something, what did I say early on? I'm expecting a lot of volatility this specific day, this specific time. It's like clockwork. It's just clockwork. It's based off data. So that's why I specifically picked today, this time, to showcase this model, because expectations are we should have pretty good amount of volatility, right? So a couple things to look out for here. Can we tap this weekly root? Boom. There you go. Slap back on. Now, am I going to long immediately down here? Nope. I need to find an entry criteria, whether that's an order block, change in the state of delivery, inversion, etc. So I need to frame an entry criteria now. What this means is we're at the point of interest. Definitely a discount here. Again, this is for educational purposes only, just show and talking about what's happening here. But let's see if there's a reaction off that weekly root. No, I love that. That's amazing. Yeah. We had a question on what AMRP is. That's average model range probability. So the probability, like I mentioned earlier, that price will move how far within this time to this time, right? So now what we're seeing, it's not uncommon, specifically for Thursdays, Model 1001, to have higher volatility than usual. And that's kind of what we're seeing now, right? Again, if I'm looking for an entry criteria for longs, no, I really need to see a setup form. And what I look for in this occasion is I observe fair value gaps. If we're going to have a pretty quick liquidity run like we're seeing now at exactly 1 p.m., then I'm going to have to watch these fair value gaps. What do I mean by that? So let's take away the indicator for just a brief second. This is just now using price. If we're not stabbing into any of these inefficiencies, there's no tap into them. What does that tell you about price? It's in a rush to go somewhere, right? We have all this liquidity down here. So any of these fair value gaps, this is what I tend to do on these runs. I watch how price reacts off of them. We got another one down here. Now watch how it crawls back. This is a type of setup that I like to call mean reversion. Okay, we'll see if it happens today. What we need to see first is possibly have an inversion here. However, what does this mean? It means we're overextended. Like we're way beyond the volatility on average. Let's make this larger. So this is the table. So easy to read. This is the current range we're in. You can see we're at 85, kind of spilled over and overextended. Normally, we're supposed to be at 74, right? So what does this mean? It means that we're experiencing more volatility than usual. On these occasions, what can we expect? Either a continuation and maximum volatility or mean reversion. A mean reversion is just a reversion back to the mean. What is the mean? Just the opening price. It's up here. So does it mean 100% we're going to slap back up there? No. First, we need to see price respect. If it can close above this, respect that and proceed back up. Whenever you have a mean reversion back to the mean, that's all it is, right? Possibly. You'd like to see, number one, price proceed back to its AMRP. That's like the first area of interest. Secondary would be this upper area here. Last would be the opening price. And then best case scenarios, it happens sometimes, it just keeps going to the next AMRP up there. It ping pongs back and forth. So that's what I look for. As you can see here, just based off price, I'm simply just looking at the fair value gap. Are we closing above consequent encroachment? 50%, right? So simple. Are we just closing above? Are we disrespecting the starting point? Are we wicking above? As we can see, it's already showing signs that it's starting to trying to push above, right? So there's no confirmed close yet, but it's knowing where to look for and frame these possibilities. That's what DTT is pretty much. Just maximizing your risk to reward, having targets that aren't existing without data, right? If I didn't have data, I wouldn't have this potential target for a possible short and or possible long up here. But any questions here? I am pretty happy to see that, we're getting that volatility today. It's expected, and it's just nice to see, day in, day out. Yeah, really well said. To add to that, you know, I mentioned that we're gonna probably approach AMRP and go below it. Looks like there's a lot of volatility. Something I want to add to this is, can this thing just plummet to the ends of the earth and just keep going? Possibly, we could keep going further down. However, what's important to understand here is that, like I mentioned, this is the maximum volatility range. Like, this is how far price should go on average with data. Now we've overextended that. So any latecomers here that are shorting, trying to short this probably fair value gap I mentioned earlier, they're going to have a tough time because of that reason. We're using a data metric. It's so simple. You just slap it on. You're like, okay, we're at an absolute discount. Should I be framing shorts? Probably not, especially with the higher time frame being really bullish. I should probably be looking for a long setup down here. So, like I mentioned, anyone that's seeing this price action just raw like this, right? They'll gravitate towards these fair value gaps here, and they'll start to try to short off that, probably putting their stop here and there. And I just want to say it outright, like, it's important to understand where we are. And if we're in discount, I'd probably wait. If I really want to short, I'd probably have to wait for price to retrace back up here. That involves patience, but with patience, you can see maybe there's a better opportunity up here, right? Instead of shorting the first fair value gap down here below this magical box here, AMRP. And as you can see, with the fair value gap, let's zoom in there. Like I mentioned a few minutes ago, we already saw some warning signs that price was not going to hold this thing. Look at that. Closed above 50% with a body, specifically with a body. Started to consolidate. And then what do we see here at this candle? Closed above the entire thing. So obviously I'm not going to be using that fair value gap to short. And now we'll see if there's a possibility of a mean reversion, as we talked about earlier. And with a mean reversion, your first targets will be, if you are looking for that reversion back, this will be your mean. You would then look for price to go to the bottom of AMRP. AMRP in of itself, the upper area of AMRP. This box is just this standard deviation off AMRP level. And then from there, you'd like to see better case scenarios, price go back to the open. Even better case scenarios, I mean, this doesn't happen all the time. Don't expect it. I'm just saying better case scenarios, you'll often see price just shoot all the way back up to the opposite AMRP up there, okay? So that's what we look for day in, day out. It's just knowing when to expect volatility, because that's all time is. Time is literally just volatility and reversions back to opening prices. That's it. Yeah, I love that. We've got a couple questions here. Does anyone else in the community use this with other instruments? If there's anyone from the DTT community, feel free to speak up. I'd love to hear what you guys have to say about incorporating this into, your daily trades or weekly trades. I'd love to hear what you guys think about it. So let us know your thoughts. I know a few of you trade other instruments like crude oil and other indices, so it's always cool to see. Nice. Pancake. Pancake is a pretty good trader. She took the model 1001 short. So we have that mean reversion possibility here. Now, as price is weakening to the sell side, you're going to want to keep observing those fair value gaps as we approach price further, right? We have another fair value gap here. Let's make that a different color so it's easier to digest. We have a couple of fair value gaps there. As we witnessed in the first one, we're going to want to see the same thing. Are we closing above? Are we wicking above the starting point, 50%? If so, we'll keep seeing these being ran through, and we'll just see price catapult itself back up. This is a beautiful example, or possible example, of a mean reversion. So when you overextend the volatility, you'll see it snap back. Always watch those fair value gaps that form. I think this happened more recently. The most recent example I can think of might have been during Asia, but this tends to happen a lot during Thursdays and Fridays in the PM session. So we'll have all these fair value gaps here, right? Just watch those, see how price interacts with those. Nice, SMT Trinity. So you've been using it for a month. I know you've been getting some nice payouts. I saw that. So good job on that. Yeah, but that's pretty much it. Like, it's so basic and easy to understand. If you guys are having a tough time knowing where and what to look for, that's why you can slap on this indicator and just know this is premium and discount. I'll look to frame longs here, shorts up here. If I'm bearish or bullish on the day with my daily bias, right? It's really that simple, to put it simply. Obviously, there's a lot more golden nuggets and information I haven't talked about here, but those in the community know a little more about what I'm talking about, such as what Anar mentioned. If you guys wrote that down, highly suggested. If you have access to the indicator, root SMTs. I think Judy's in here, right? You love using root SMTs. She's a really good trader too. So, yeah, well, obviously I can't give out all the details, but the magical floating box originated just from, let me put it simply, like, what is time, right? That's the question I have to ask everyone. If you think about what time is, everyone talks about it online. What is it? It's just volatility. So when you're looking at specific candles, you look for candles that tend to have more volatility. You look for candles that price gravitates back towards, right? And so in the research stage, that's what those root candles are. It's just a way to gauge discount premium, but also volatility and a draw on liquidity. And so as price rejects off of it, it's pretty clear that it's respecting it quite a lot, right? Same thing here for the previous root candle. If we go back to ES, look at that. Such a beautiful return back. It's having a stronger move than the NASDAQ. But point being, the root candle reaction off that, right? And of all the candles here, you can have and look at all these candles here, but which candle did it have a reaction off of? This one here. So you tend to see that quite often. Obviously, that's just the gist of it. I can't really give too many details, but it's just simply a way to look at volatility more in depth, right? So the hard work is done for you guys, but it's there for you guys to utilize, and I'm always happy to see people being successful with that and utilizing it and incorporating it into their trades. So, any other questions that we have here? It's cool. There's a couple nice comments. First of all, let's see. Ollie, constant frameworks throughout the day. That's my favorite thing about DT. Exactly. So you have the same thing happening day in, day out, same framework, and it's the same exact deal every day. So you know where your discount premium is, you know exactly what time to target, and how much volatility you should expect, right? That's the beauty of it. It's algo asks, is there a model I suggest to people just starting out using this? Definitely. So my two favorite models for the New York session, without a doubt, is this one specifically. As you can see, just look at the volatility on this. Beautiful, right? Another one is Model 11. So it's all the way over here. This tends to have really beautiful movement as well on specific days. So if you guys want more info on this, just read the free book. It's also a newer version. Who's excited for that? Coming out later in the month. Putting a lot of hours into that. So I hope you guys really enjoy it. But this model here and the model we're observing, those two, that's where we can expect more volatility. So if I turn this on, if you're just starting out, using this and incorporating it, I would use these two models, Model 11 and Model 1001. Why? Because we can expect more volatility in those models compared to the other ones. So you have a bigger chance of a bigger trade, to put it simply. So there's a question on what time frames do I use. Again, it's better to simply look at the 5 or 15. It gives you that story you're looking for, right? With order flow, you simply engage with price thereafter. If I see price heading towards a specific liquidity pool on the 5 or the 15 minute, then I can simply engage with price on the 1 with these models here, right? If I want a sharper entry, okay? There's a question on the table in of itself by Judy. Yeah, so if we turn this all on right here, all models, right? Let's quickly look at the volatility measurement. Obviously, this looks like, whoa, there's a lot of names, there's a lot of numbers, but again, if we just go back to what it was, each model has a range, then it has its average range, and then these are the probability levels. That's it. So if we look back at all of these models for the rest of the day, we would like to see which ones had lower or higher volatility than average. So if I ever see any of these here experiencing lower volatility with a look back of 9 or 6 or 3, so let's go quickly to 3 and we'll talk about it. I will look to see if one of them overextends. Case in point, this model here, normally it's supposed to be 22. Instead, it was 24. Let's quickly look at this model and then see what happened, right? Is there a possibility of a mean reversion? Was there more volatility? What happened? And let's look about what happened in the next model thereafter. This is why this table is so important. If we have more volatility here, the next model might not move too much. This happens quite frequently. So write that down because it's pretty often. We can even see in the next model here in the PM session, this model moved quite a lot. The next model might not move too much. So let's briefly look at this model and this model and then see what happened there, right? So this is the model. These are AMRP levels. This is Asia session, but you notice how just easier it is to digest because you have these levels on here. And so if I'm looking at price, I will then look to see, is it overextended? As you can see, it pops above its AMRP. So the next model, is there a possibility of a continuation of a trend from this reversal here? Obviously, I'm not just going to look straight up at the 1 minute, look for some entry and assume it's going to do what it wants to do. Again, I need to look at the 15 or the 5 for a better entry criteria. But from here in the next model, I can either frame a continuation or, because we overextended, simply put, I can just anticipate a possible consolidation. And as we can see, price did not move at all in this model. This is what you would call time distortion. Pretty famous term, but that's all it is when you enter through an opening price, you come out at the same opening price within this time to this time. That is time distortion right there. So that's how you use the table. That's how you incorporate it, is expecting volatility or not expecting it, right? It helps you understand when you should expect it and when you shouldn't. Yeah, we've been tapping into this root candle on the weekly quite a bit now, I believe. As we can see there. All right, so I think I will conclude the stream there. I mean, I hope it was insightful. We got through this entire model here and just beautiful price action. I hope you guys learned some things about DTT or some new things about it. And yeah, I hope that was helpful and insightful as to how to incorporate it.